Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Tim Stenovec in for Matt Miller. Katie, government's not shut down.
I know, blowing up all of my narratives. Yields are higher though, so let's get into that now because the biggest stories in the more than 10 trillion global ETF industry, it all comes back to the Fed. And today we heard from Fed Chair Jerome Powell, who says that he's focused on, quote, supporting a healthy economy as Jamie Dimon sees interest rates possibly going to 7%.
And in just a few moments, we've got a wide-ranging conversation with DoubleLine Capital Deputy CIO Jeff Sherman, including what to expect as we enter the fourth quarter.
And the first ever Ether futures ETFs are making their U.S. debut today, finishing off a years-long battle centered on the second largest digital token. We're going to get into all of it, Tim. Don't worry. But
okay, I'm not worried. I'm not worried.
As always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, take it away.
Katie, Tim, thank you. So, look, the flows are interesting. You know, I saw Jerome Powell just a second ago up here. That is definitely influencing the flows, you can tell. First of all, IBV, that is a lot of money, $6 billion. I think that's BlackRock or Merrill's model. So that's a good sign if you have an institution like that rotating into the S&P. But then, boom, you got a bunch of Treasury ETFs, VGIT, TLT, which again, to me, reminds me of a siren call, luring all these investors to try to play a recession or rates going down, and it continues to not work. It's lost $5 billion in cash burn this year in that trade. And then JP Morgan, again, with more active hits. They just keep coming. BND also on the board. Let's look at the outflows, and you can see it's also a little bit of a mixed bag here. Some, LQD, that's probably, again, BlackRock or Merrill's model rotating out of that. That's interesting. Could be going into treasuries, not sure. The Q seeing outflows, you hate to see that. IAU seeing outflows, that's gold. That's interesting. EZU, that's interesting. Also, that's an emerging market. 2 emerging market outflows. So kind of a mixed bag there. I'd say it's kind of a toss-up in terms of bullish or bearish this week. Let's look, though, at the first screen I showed you, which was the flows into some of these treasury ETFs like VGIT and TLT. Right, there's a bunch more on here, and I'll point them out in a minute. I want to go over this direction here and look at the year-to-date return. Negative a lot. Negative. Treasuries are down. Even the short duration ones are down. TLT down 9%. Again, that's $5 billion cash burn in that trade. So people keep coming back and back to this treasury trade, wherever it is on the curve, but TLT in particular, and they just can't win.
They just can't win. They keep on losing. And let's talk about that now with Jeff Sherman. He is Deputy CIO over at DoubleLine Capital. Joining us on set, Jeff, it is great to see you. And let's talk about the bond market. We'll just start with the price action because it has been incredible. You look at 10-year Treasury yields up something close to 80 basis points in the last 3 months. What's driving that? What's going on here?
Well, the narrative has shifted. At least that's been the explanation for the movement we've seen. I'd say 2-3 months ago, no one cared about deficits. I mean, yeah, people talked about it. All of a sudden, we talk about this newfound U.S. resurgence in growth, that the U.S. is infallible, and that narrative has really caught hold. If you look at it, I mean, we've had that reverse over 2 months, but like 60 of it's been the last 1 month. And so it just seems with the dysfunction in Congress, this is now at the highlights. But ultimately, there still is value in treasuries. And Eric talks about the cash burn in that trade, but that trade will work. It's just in the short term, things go against you for a while. But the momentum's been horrific. There's this idea that the yield curve is going to steepen to teach Congress a lesson, and that ultimately that's going to bring them to their senses about deficit spending. But as we saw, we have another 6-week extension. Nothing's changed over the course of the weekend. And so ultimately, now there's just better yield out there. And I think that's what you're seeing in some of these models that Eric brings out, as well as investors' preferences right now.
Well, that's exactly where I wanted to go to bring in what Eric was saying. You look at TLT, it's down 9% on a total return basis. It's taken in almost $17 billion in year-to-date inflows. What's behind that? Is that just people trying to lock in higher yields?
Yeah, ultimately that's what it is. And I think Eric said it too at the top of the set here, was that ultimately people are playing for a recession. And so, we know that third quarter GDP is going to be very strong, right? But remember, GDP is one of the most backward-looking indicators, right? And so even going to the last recession we had, and I'll call it the '08 recession, GDP was still almost 2.5% in that last quarter. So the idea that the U.S. economy is going to continue to fire at this 3-handle rate, I think that's what consensus is for the third quarter. It's just not tenable at this stage. We've seen excess savings decrease. We know student loan payments are there. And let's not forget about the big elephant in the room, and that is significantly higher oil prices right now. And so these things inherently are going to be some drag on the consumer. And so it doesn't mean that just because we have a slowdown, it has to be recessionary. But yields do look a bit high, especially on real yields at this stage for where we are in the cycle.
So what is your outlook for a recession? Because last time you were on with us back in June, you said a recession was in the cards over the next 12 months. But as you mentioned, since then we've seen oil go from about $70 a barrel to $90 a barrel. We got the UAW strike, which according to Bloomberg Economics could shave off a full percentage point on GDP in the fourth quarter. What's your view on when or if there's going to be a recession?
Yeah, it still looks like it's going to be something in the middle of next year, middle to late of next year. And again, these are hard to nail the exact timing of it. And just because we've had good economic data doesn't mean that you should be on reprieve at this point. You mentioned all the reasons that recession risk should be rising, not falling at this stage. And so, again, the strikes are not a good thing. Oil prices being higher is not because there's this massive demand. It's a supply side part of the equation. And I noticed I filled up my car with gasoline, unfortunately in California, one of the highest places for gasoline, and we're back almost to price that we had with the Ukraine invasion.
You don't have an EV?
I do not have an EV at this stage in the cycle. Like, we do have a hybrid type of thing.
Everyone in California has EVs.
Yeah, but the hybrid makes more sense until they have all the infrastructure. I just can't wait an hour at the place. I mean, look, time is money. We all say that. But ultimately, there are better ways to do it, too. You can electrify your house and those as well. But that being said, I think what we have right now is really a setup for the slowdown in the consumer. And again, this doesn't mean that we need to fall down, that the recession needs to happen, the consumer is going to fall apart. But what it does connote to me is this entire move that we've seen has been real yields. This is not because of a higher inflation environment. It's this extrapolation from this good data we've seen over the last 6 to 8 weeks.
When I see all the money lost in TLT this year, you see this every 3 years. A trade is just so attractive and it just never works. I do think of laddering. You know, laddering is sort of a Fred-proof way to make your portfolio. You don't have to worry about the recession or the Fed. Is there a case against laddering, which is, again, to go 10 years out each year and then, sell the one and then buy the next year out? Is there any reason not to do something like that when it's so hard to pick it?
Yeah, no, I mean, look, picking bottoms in any market or tops in any market is notoriously difficult, and it's hard to get right more than once or twice in a career, let alone be persistently correct. And so I still don't think there's anything wrong with it. I get the pushback from clients is, why don't I just ladder a bunch of T-bills, roll 6 months and then roll that from one, because that trade has not lost money too. And so the front of the curve is attractive, but what I remind folks is that it has risk, and it's not risk of the government default, it's risk of reinvestment as well. And so I think what you're finding is that people see this, they see the real yield out there, they don't believe that we're going to be in this higher inflation environment that is a 3, 4, 5% inflation environment of the longer term. And so there is value in locking some of that in. The biggest risk to this is the deficits, right? And so over the short term and the nearer term, we do think that trade does make a lot of sense. Do I want to own it for 30 years? Absolutely not, right, at this stage, just given how dysfunctional things are out there. So from the standpoint of trying to ladder or invest, I mean, it's exactly what we talked about last time on the show, is that it's not just about rates, it's also about credit, too. And since then, credit has worked, right? And so putting those two trades together still makes sense in today's environment. And by the way, we're now at cycle highs, right? 5s, 10s, 30s, as of today, are at new highs in this cycle. And so for those that have been patient and sitting in some of those trades on the front of the curve, rolling T-bills, sitting in cash, it is a time to start moving outward a little bit. And if you're scared about it, start at the 5-year part of the curve, right? You don't have to go all in at the 30.
All right, Jeff, we have to take a break right now, but you'll be sticking with us, and we're going to talk much more about the credit market next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with floating rate ETFs. Specifically, we're talking about BKLN rate here. We've talked about what a brutal year it's been for the bond market, but you take a look at this floating rate product. It's on track for maybe a fifth straight month of outflows after it took in more than $600 million in September. That was its best month, I think, all year or so. So a lot of love for the likes of BKLN. But then we were talking about TLT, and it has just been a washout there. You're taking a look at the total drawdown. It's down about 45% since its peak. That is a record, and yet money keeps going into that long Treasury product. Where it's not going is into the likes of JNK, junk bonds. And this is the opposite story. JNK, it's actually on track for total returns of about 5% so far this year, and yet no one wants to buy it, Tim. As you can see, it closed out a third straight month of outflows. All told, JNK has lost $1.9 billion in 2023.
Oh, no love. Well, that's what I want to get to with our next guest, who has stuck with us. Back to DoubleLine Deputy CIO Jeff Sherman, who joins us here at Bloomberg headquarters. So, Jeff, as Katie just mentioned, the outperformance of junk bonds is something we're certainly watching, but why has it been so unloved?
Well, I think what you have is you have duration again, right? And so we just talked about the interest rate risk of TLT. JNK probably has a duration kind of in the mid-4s versus something closer to like 17 or 18 for TLT. And so it's just that sensitivity there. And, you know, people have been playing the recovery in junk bonds throughout the year. Right? Junk bonds have done well, 5%, you know, when you juxtapose that against what we see in the rates market. But some of the challenges with the floating rate side, and you saw this with what you mentioned, BKLN, is that these are the credits that are most at risk in this type of environment. And what I mean by that, if you think about the Fed's hiking regime, this 525 basis points they've delivered to us over the last 18 months, it is evident within the floating rate market, right? These borrowers have to pay north of 5% more than they were 18 months ago because of the coupon reset. So these are the most at-risk issuers to Fed policy today. Now, some of them have bridged the market and went to the high-yield market as well. But you've seen weakness in high yield as of late as well. But spreads are kind of tight-ish in that market, and you've actually seen some refi activity within the high-yield market over the course of the summer before this last push up in yields, where people are trying to get ahead of the maturity walls that are coming next year. So I think what you're seeing is that people are fearful of a slowdown. I think if you look at the flows to me say that people are trying to counter trade this market, right? They're selling the stuff that's done well. They're trying to buy things that look a bit cheaper on there. And I wouldn't expect a 45% return on TLT over the next 12 months or so. But definitely you could do something in the double digits if we realize that rates are too high for the current environment.
You know, I love to throw these sort of shiny object bond ETFs at you, just to get your take. So this one I want to go over is JBBB. This is a Janus triple B CLO ETF. So it's one of the first high yield CLO funds. It's the second best performing bond ETF of the year, up 11%. As you can see, it's destroying everything. Not a lot of flows. What's the pushback here? Why wouldn't I go into this?
Right. Well, one, it's done well because it did very poorly last year, unlike JAAA, right? The AAA part of the CLO capital stack. You had significant losses. And look, full disclosure, we own a fair amount of BBB CLOs within our portfolios, and you can open up our ETFs and see that in there. And they've been a great performer in the market. The problem is some of this is familiarity, one, and understanding the liquidity profile of the underlying assets, too. And so, again, I'm not here to speak on why investors haven't particularly flocked to that ETF, but it definitely has significantly more risk than the AAA part of the capital structure. So we still like this part of the market. We do think that the Fed stays higher for longer, as the mantra has been for a long time. We never believed in the rate cuts this year type of argument. But ultimately, that is where the most credit-exposed risk is. So if you think about these parts, and I don't want to get too wonky on tranching and all the losses, but if you have a significant default experience within the loan market, remember that was just my concern talking about bank loans over high yield, and you have lower recovery rates than you've seen in the past, I don't think the BBB tranches themselves are at risk for principal impairment, but the ones right below that, which that ETF does own some of as well, are at risk for taking pretty severe principal losses. And so, again, it's just understand the nuance there. I know I've got a lot of people on the street that are going to ping me later on today and say, Jeff, why are you out there bashing, BBB CLOs? And I'm not doing that, but I think it's just not really understood by the marketplace, and it's really more of a professional type of area to invest in.
Well, Jeff, I do want to open up one of your ETFs. If we look at the DoubleLine Opportunistic Bond ETF, the ticker there is DBND. I take a look at the holdings and the top assets right now. You have 48% of the portfolio in mortgages. Then you have about 27% in corporates, and then 24% in government bonds. This is an actively managed ETF. Is that how the allocation mix typically looks?
Well, no, because it's active. We have views on the marketplace. And if you look within that mortgage-backed securities, it's split to pretty evenly between the agency mortgage market as well as the non-government guaranteed, or we call the RMBS market. And the RMBS market has been stellar this year. It has significantly less duration than even the high yield market. It has a little less yield, obviously, than the high yield market, but you can buy high quality bonds in that space that have 7-handle yields today. You look at the agency mortgage market, and to Eric's point of people looking for a trade that got cheap and just hasn't done anything, none other than the agency mortgage market. Spreads there are some of the widest we've seen in 15 years because, again, a lot of the bank demand stepped away with some of the banking problems we had earlier in the year, but also just there hasn't been this flock back to it, that part of the market. And so the reason that there's that significant exposure to that segment of the marketplace today is, one, we can get a government guaranteed asset or a government backed asset that has significant yield pickup to treasuries, right? It behaves like treasuries in a risk off environment, and we don't have to worry significantly about a lot of the prepayments in there because of where the coupon stack is. And so in general, we find that those parts of the market are very interesting to us today, and they have yield pickup to other parts of the market with different risk profiles.
Jeff, I've got a producer in my ear. We got to go. But in 10 seconds or less, credit risk or duration risk right now, which are you more comfortable taking?
Given the sell-off, I like duration risk a little bit better today. I still like the credit we own. You can hear it. You can see it from the portfolio, the way they're positioned. But I like the duration risk given the sell-off and where yields are today.
I think that was 12 seconds, but that was pretty good. Jeff, it's great to see you, as always. Jeff Sherman, Deputy CIO over at DoubleLine. Thank you so much. Now, still ahead on ETF IQ, we take a look at today's unprecedented debut of Ether futures ETFs with Lara Crigger. She is editor-in-chief over at VettaFi. Next, this is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Tim Stenovec, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence here with us for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, we don't have one today. It's a special day, Katie. This is an unprecedented day in the history of ETFs. Never seen this happen before. We have a multitude of Ether and Ether plus Bitcoin futures ETFs launching all on the same day. Remember when BITO launched? That was 2 years ago. Those Bitcoin futures, only one launched, and it got like all the volume, basically. So the SEC was like, well, we don't want to do that anymore. Let's have them all out to have fair play. So here's the ones all in the market trading today. There's their volume. I kind of sorted it by the most volume as of noon. Total of $2 million trading. Not that much. Although compared to a regular launch, it's a lot, but it's not a lot versus BITO. So little less interest in here, interest in these. And it's going to be an interesting to watch these ETFs jockey per position, because the one that gets the most volume typically gets the most assets and has a lot of pricing power. So, Katie, this is a derby, I call it, and we're going to see who wins. It's very early still, though.
All right, Eric, thank you. You really sold it. And joining us now to talk about it is VettaFi editor-in-chief Lara Crigger. And Lara, at the end of the day, is this just much ado about nothing? Is there really going to be sustainable demand for an Ether futures ETF?
I'm not so sure. I'm not really convinced. I mean, anything can happen, of course. But if you take a look at the Ether market, it's about 20%, 25% of what the market cap for Bitcoin is. So, and on top of that, retail and institutional demand for cryptocurrency in general is drier than the Mississippi River these days. So,
This is exactly what I was asking Eric about on our call earlier today. I'm like, okay, what is this, 2021? I mean, why are we talking about these? I thought we were in a crypto winter.
yeah, I can't really see that there's going to be a ton of sustainable demand for Ether futures ETFs. Anything could happen, though, of course.
Yeah, but okay, I should say, it's not just that it's interesting because all these ETFs are launching at once, but this is sort of an undercard to the real race coming up probably in the next 3 or 4 months, which is the spot Bitcoin ETF race. Now, I would say there's going to be much more demand there. Do you think that'll be muted, or you have more optimism for that one?
I think if the spot Bitcoin ETF race had happened last year, when all of the hype and the frenzy was, at full throat, it would have been a different story. But I can't really see that it's going to be hitting the same fever pitch that it did last year. So.
All right, Lara, I'm going through your notes. I see Ether ETFs, active ETFs, and I see Cannabis ETFs. Matt Miller is off today, so I'll do this for him. What's going on with Cannabis ETFs?
It's really fascinating, actually. We had this huge spike in prices in the Cannabis ETF market last week and the week before, and really since August 30th, when there was this news that came out that the DEA might reclassify cannabis from Schedule 1 drug to Schedule 3 drug, which would put it on the same level as ketamine and testosterone and some other drugs. So that would change the regulatory picture for cannabis, which would open a lot of doors for cannabis companies. There's that sort of price rally has been factored back in. It's kind of come off a little bit of its highs. There was last week as well, the Safer Banking Act that passed out of Senate Banking Committee to be considered on the full Senate floor. It's anybody's guess whether that's actually going to happen now that the shutdown is, at its full throat.
When we talk about the Safe Banking Act, I mean, I've been talking about the Safe Banking Act for, as long as I've been talking about cannabis stocks and cannabis ETFs. And it's like, is it ever going to happen that, these cannabis companies will be allowed to actually, work with traditional banks and work with credit card companies? Because that's what this would do. But it hasn't gotten anywhere.
No, it really hasn't. And I think the Safer Banking Act is an incremental step forward, but what really needs to happen for the cannabis industry to flourish to its full potential is for something like the Safer Banking Act to pass and for the rescheduling. But even then, there's still some problems.
You also have uranium in your notes. I love this. This is my pick for ETF of the year 3 years ago. Even though I lost, I probably should have won because it's up like 300% since then. But I digress. You say, what's the difference between going with the miners, right, versus spot? You can't get spot in the US, but you get in Canada. What's your take there?
I think that if you take a look at what's on the market right now, you can either get spot uranium, or excuse me, not spot, but you can get pure play uranium miners, or you could get a blend of uranium miners and nuclear power plant manufacturers and so on in some of these nuclear power ETFs. The ones that are really taking off right now, though, those are the uranium miners ETFs, the ones from Sprott, the URNM and URNJ.
And just really quickly, I was just going to ask, who's buying them? Because it's so niche. Is this retail?
I think a lot of it is retail interest, but it's also people who are looking for a energy solution that is actually going to work. Right, in the new economy. There's been a lot of hay made about solar and wind and carbon capture and everything, but there's a lot of potential for nuclear.
All right, Lara, we got to leave it there. It's great to see you. Our thanks to Lara Crigger of VettaFi. And that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Eric Balchunas and Tim Stenovec.